If I told you that two friends invested the same amount of money in the same fund over the same number of years, but one ended up with lakhs more, just because of how they invested, would you believe it? It sounds like a riddle, but it is a simple truth of investing. Hey everyone, welcome back to the channel. Today, I'm sharing a story that will finally clear the confusion most Indians have. Should you invest through SIP or Lumpsum for long-term wealth? The world of money can seem complicated, a confusing jungle of jargon and charts, but at its core, it often comes down to a few simple choices. One of the most common choices every investor faces is this: do I put all my money in at once, or do I invest it bit by bit, month after month? This isn't just a technical question, it's a question about your money, your temperament, and your future. This choice separates two powerful strategies: the lump sum investment, the systematic investment plan, or SIP. A lump sum investment is exactly what it sounds like. Meet Arjun, meet Riya. They are good friends. Both are 25 years old. They work for the same company in a bustling city. They share a common dream: to build enough wealth to retire comfortably. After years of careful saving, each plans to invest rupees 12 lakh into an equity mutual fund over the next 15 years. They have the same amount of money and the same time horizon. Yet their paths could not be more different. Two distinct financial journeys. Arjun receives a significant one-time bonus from his company. He gets the full rupees 12 lakh in a single payment. He has read, "Time in the market beats timing the market." Believing this, he decides to act decisively. He thinks the market generally goes up over the long run. The sooner I get all my money working for me, the more time it will have to compound and grow. So he makes a lump sum investment, one transfer, all in. His work is done. Now he waits for compounding. Riya's situation is different. She doesn't have a large sum saved up. She has a steady salary and a disciplined habit of saving. She chooses a systematic investment plan, a SIP. To reach 12 lakh in 15 years, she needs about rupees 6,500 a month. She sets up an automatic monthly investment with her bank. She doesn't have to think about it. It just happens, month after month. So the stage is set. Arjun's entire 12 lakh is in the market from day one, exposed to every rise and fall. He is a passenger on the market's journey. Riya is slowly and steadily buying her way into the market. She buys when the market is high. She buys when the market is low. Her journey is a series of small, consistent steps. Both friends feel good about their decisions, confident they've made a smart choice for their future. For the first few years, the market performs well. Arjun is thrilled. He checks his portfolio and sees his rupees 12 lakh growing steadily. He feels smart for having invested it all at once, maximizing his exposure to the rising market. Riya also sees her small monthly investments growing. She is happy with her progress, building her wealth one step at a time. Then, 5 years into their investment journey, the unexpected happens. A global economic crisis hits, and the stock market crashes. Panic fills the news headlines. Stock prices plummet by 30% in a matter of months. This is the first real test of their chosen strategies. Arjun's world is shaken. His lump sum investment, which had grown so nicely, now takes a massive hit. He logs into his account and sees that his portfolio value has dropped by nearly 30% from its peak. The lakhs of rupees in gains he saw on paper have vanished, and even his initial principal seems to be eroding. Fear starts to creep in. Every news report about the market falling sends a jolt of anxiety through him. Did I invest at the wrong time? Should I sell now to prevent further losses? The emotional toll is immense, a constant weight of worry on his mind. Riya's experience is completely different. She too sees the value of her accumulated investment go down. But her perspective is not one of panic, it is one of opportunity. Her SIP continues to run like clockwork. That same rupees 6,500 she invests every month now buys significantly more units of the mutual fund. The price is 30% lower, so she gets more units. She understands a simple concept. When things are on sale, you get more for your money. She feels calm, almost detached from the daily market noise. Her automated plan is doing the smart thing for her, buying more when prices are cheap, without her having to make any stressful decisions. This period of crisis highlights the profound psychological difference between the two approaches. Arjun's journey is a white-knuckle roller coaster ride. All his capital is at risk, and every market dip feels like a personal financial disaster. He is tempted to make an emotional decision, like selling at the bottom, which would turn a temporary paper loss into a permanent real one. Riya's journey, however, is like being in a sturdy vehicle with shock absorbers. The road is bumpy, but her automated, disciplined process shelters her from the panic and even allows her to benefit from the downturn through rupee cost averaging. Arjun remained invested. Riya remained invested. The market has recovered from the crash and has delivered healthy returns over the long term. Section 4. The Numbers Game. A tale of compounding. Let us fast forward to the end of the 15-year period. Now comes the moment of truth. Who has more money? To understand this, let's assume their equity fund delivered an average annualized return of 12%. This is realistic, though not guaranteed. The final numbers might surprise you. In Arjun's case, his entire 12 lakh rupees was invested from the very first day. His full capital had the entire 15 years to grow and compound. A one-time lump sum of 12 lakh rupees at 12% for 15 years becomes approximately 65.68 lakh rupees. His money worked harder because the entire amount was in the market for the full duration. Now let's look at Riya. She invested 6,500 rupees every month for 15 years, a total of 180 months, also in a fund averaging 12%. While her total is also 12 lakh rupees, her money was invested gradually. The first 6,500 rupees had the full 15 years to grow, but the last 6,500 rupees she invested had only 1 month to grow. The average investment period for her money is much shorter than Arjun's. The final value of her SIP, using a standard SIP calculator, is approximately 50.53 lakh rupees. On paper, the conclusion seems clear. Arjun ended up with over 15 lakh rupees more than Riya. If we stopped at the final numbers, the lesson would be simple. Invest a lump sum if you can. But money is never just about the numbers. It is deeply intertwined with human emotion. It is deeply intertwined with discipline. It is deeply intertwined with behavior. Arjun may have ended up with more money, but we must consider the cost of his journey. His path was a volatile one. He experienced the full, gut-wrenching force of the market crash. The 30% drop in his portfolio was not just a percentage. It was a loss of lakhs of rupees on paper. It became a source of immense stress. It caused sleepless nights. The biggest risk for a lump sum investor like Arjun is not the market. It is himself. During that crash, the temptation to panic and sell is enormous. Had he succumbed to fear and pulled his money out at the bottom, his final returns would have been decimated. He might have ended up with far less than Riya, or even less than his initial investment. Arjun's higher return was conditional. It depended entirely on his iron will to stay invested through the worst of times, to watch his wealth evaporate on screen and do nothing. This requires a level of emotional fortitude that many investors, especially new ones, simply do not possess. Riya's journey, while yielding a slightly lower final amount in this specific scenario, was far smoother. The SIP framework imposed discipline. By automating her investments, she removed emotion from the equation. She didn't have to decide whether to invest during the crash. The decision was already made for her. Rupee cost averaging, buying more units when prices were low, gave her a sense of control and confidence. She was not just passively riding the market, she was actively taking advantage of its volatility in a systematic way. This peace of mind is an invaluable, though unquantifiable, return on investment. Riya built a powerful, lifelong habit of consistent saving and investing. She learned to ignore the short-term market noise and focus on her long-term plan. Her strategy was designed to protect her from her own worst instincts, fear. Her strategy was designed to protect her from her own worst instincts, greed. For many, a strategy that delivers a good return with less stress is far superior to a strategy that promises a great return but comes with a high risk of emotional burnout and making a catastrophic mistake along the way. Section 6. The best path is the one you can walk. So, after following the journeys of Arjun and Riya, which method is truly better? The simple, honest answer is this: there is no single best method for everyone. The superior strategy is the one that aligns with your financial situation, your emotional temperament, your ability to remain disciplined for the long haul. Both the Lumpsum are effective tools for wealth creation. The choice depends entirely on the person wielding the tool. The most important factor for investment success is not picking the perfect entry point, but simply staying invested. If you have a large sum of money and the stomach to watch it fluctuate without panicking, lump sum investing can be more rewarding. Mathematically, giving your money more time in the market often leads to greater compounding and a larger final corpus, as we saw with Arjun. However, this path requires immense emotional discipline. You must be willing to ride out the storms and trust in the long-term process. If you are an experienced investor with a high risk tolerance and a long time horizon, this could be the path for you. Conversely, if you are investing from your monthly salary or the thought of a large market drop makes you anxious, the SIP is your steadfast ally. It is the perfect tool for building wealth gradually and systematically. It automates discipline, removes the temptation to time the market, and turns volatility into an advantage through rupee cost averaging. The SIP journey is less stressful and dramatically reduces the risk of making a fear-driven mistake. For the vast majority of people, the steady, calm, and disciplined path of the SIP is the more sustainable and therefore more successful choice. Ultimately, the debate between SIP and lump sum misses the most crucial point. The worst decision is to do nothing. Waiting for the perfect time to invest or getting stuck in analysis paralysis are the biggest destroyers of wealth. The key is to start now with a plan you can stick with. Whether you take a single leap like Arjun or a series of steady steps like Riya, the goal is to get on the path and keep walking. Choose the method that lets you invest consistently and sleep peacefully. That is the true secret to building long-term wealth. Now tell me in the comments, are you Team SIP or Team Lumpsum, and why? Your answer might help someone start their investment journey today. Both work. The best method is the one you can stay consistent with. Thanks for watching.